Elizabeth Holmes. Elizabeth Holmes was a Silicon Valley startup founder whose healthcare fraud unraveled on the 14th of June 2018 in San Jose, California, United States. On that date, federal prosecutors formally charged Holmes after years of scrutiny into Theranos, a company she claimed could run hundreds of blood tests from a single finger prick. The promise attracted billions in investment and partnerships with major pharmacy chains. Inside the company, the technology repeatedly failed. What happened was a sustained misrepresentation of capability. Theranos relied on conventional laboratory machines while presenting proprietary devices to investors and regulators. Test results were selectively reported or altered. Employees were compartmentalized and discouraged from sharing information that revealed inconsistencies. Why it happened was rooted in narrative over evidence. Holmes's authority and confidence substituted for data. Board members lacked medical expertise. Secrecy was framed as innovation. Regulators were shown demonstrations rather than full operational access. What went wrong was the application of startup logic to medicine. Failure was treated as iterative rather than dangerous. Internal warnings were ignored or suppressed. Patients received inaccurate results that influenced real medical decisions without their knowledge. The consequences unfolded gradually. Investigative reporting dismantled the company's claims. Theranos dissolved. Holmes was convicted of fraud and sentenced to prison. Financial losses were significant, but the deeper damage was institutional. The case demonstrated how performance of certainty can override proof even in systems where accuracy is not optional. Bernard Madoff. Bernard Madoff was a New York financier whose Ponzi scheme collapsed on the 11th of December 2008 in New York City, United States. That morning, Madoff was arrested after admitting to his sons that his investment business had never engaged in real trading. For decades, he had reported consistent returns that appeared insulated from market volatility. Pension funds, charities, universities, and private investors entrusted him with an estimated $65 billion, believing stability signaled competence. What happened was structurally simple. Investor funds were deposited into a single account and used to pay earlier clients, creating the illusion of profit. No sustainable investment strategy existed. The operation depended entirely on continuous inflows and confidence remaining intact. Why it happened was less technical than cultural. Madoff's reputation as a former NASDAQ chairman discouraged scrutiny. His firm's exclusivity created social pressure not to ask questions. Regulatory agencies received repeated warnings, including detailed analyses demonstrating that the reported returns were mathematically impossible. What went wrong was not a lack of information but a failure to act on it. Investigations were brief and deferential. Assumptions replaced verification. When the 2008 financial crisis triggered mass withdrawals, the absence of assets was exposed almost immediately. The consequences were uneven and enduring. Retirement savings disappeared. Charitable foundations closed. Madoff was sentenced to 150 years in prison. The regulatory framework that overlooked the scheme remained largely unchanged, having already demonstrated how credibility can delay accountability longer than evidence ever could. Sam Bankman-Fried. Sam Bankman-Fried was a cryptocurrency executive whose exchange collapsed on the 11th of November 2022 in Nassau, Bahamas. FTX filed for bankruptcy that day after customers attempted to withdraw billions in deposits that no longer existed. Bankman-Fried had positioned the exchange as a responsible alternative in a volatile industry. Public messaging emphasized safety, ethics, and transparency. What happened behind the scenes was different. Customer funds were transferred to a related trading firm and used for speculative investments, political donations, and operational losses. Basic accounting controls were absent. Large transactions went undocumented. Risk management existed in name only. Why it happened was a combination of speed and exception. The cryptocurrency sector rewarded rapid growth while lacking clear oversight. Investors and users accepted assurances in place of audits. Jurisdictional gaps delayed regulatory intervention. What went wrong was structural. Decision-making was centralized among a small group. Financial boundaries between companies were ignored. The system relied on confidence rather than segregation of assets. The consequences were immediate. Customers lost access to funds. Confidence in cryptocurrency platforms deteriorated across markets. FTX's collapse triggered investigations worldwide. Bankman-Fried was arrested and later convicted, The failure revealed how quickly new financial systems can reproduce old abuses when accountability is treated as an inconvenience rather than a requirement. Alan Stanford. Alan Stanford was a financier whose international Ponzi scheme collapsed on the 18th of June, 2009, in Fredericksburg, Virginia, United States. That day, federal agents arrested Stanford following years of investigation into certificates of deposit sold through offshore banks he controlled. Investors were promised unusually high, consistent returns backed by conservative assets. In practice, new deposits were used to pay earlier investors and to fund Stanford's personal expenditures. What happened unfolded across borders. Stanford's operations were based in the Caribbean, marketed globally, and serviced through a web of affiliates. Records were manipulated to show fictitious profits. Internal controls were minimal. Regulators in multiple countries raised concerns, but jurisdictional complexity slowed coordination. Why it happened was institutional diffusion. Oversight responsibilities were fragmented across agencies that lacked authority beyond national boundaries. Stanford cultivated political connections and public legitimacy through sponsorships and philanthropy, discouraging aggressive scrutiny. What went wrong was delay. Warnings accumulated without decisive action. Each additional month allowed losses to deepen. The structure depended on time, not sustainability, and time was repeatedly granted. The consequences were personal and prolonged. Thousands lost retirement savings. Legal proceedings stretched over years, as assets proved insufficient to cover claims. Stanford was convicted of fraud and sentenced to 110 years in prison. The case illustrated how global finance can distribute accountability so widely that it effectively disappears until collapse becomes unavoidable. Martin Shkreli. Martin Shkreli was a pharmaceutical executive arrested on the 17th of December 2015 in Brooklyn, New York, United States, for securities fraud. Shkreli managed hedge funds that suffered significant losses early in his career. To conceal those losses, he transferred assets from a pharmaceutical company he controlled into his funds without disclosure. Investors were misled about performance and risk. What happened was not a single transaction but a pattern. Corporate boundaries were treated as flexible. Funds moved internally to cover shortfalls. Public attention focused on Shkreli's decision to sharply increase the price of a life-saving drug, while the financial misconduct remained less visible. Why it happened was a reliance on opacity. Complex structures obscured accountability. Oversight mechanisms existed but were slow. Shkreli's public notoriety distracted from internal financial practices. What went wrong was normalization. Temporary fixes became routine. Investor protections were treated as inconveniences rather than requirements. The system responded only after documentation accumulated beyond denial. The consequences were legal rather than immediate collapse. Shkreli was convicted on multiple counts and sentenced to prison. Investors recovered only part of their losses. The case demonstrated how financial fraud can persist quietly, even under intense public scrutiny, when attention is directed at controversy rather than structure. Trevor Milton. Trevor Milton was a startup founder charged with fraud on the 29th of July 2021 in New York City, United States. Milton founded Nikola, a company that claimed to be developing revolutionary hydrogen-powered trucks. Promotional materials showed vehicles in motion. Announcements described proprietary technology. The company's valuation rose rapidly despite limited production capability. What happened was a sustained exaggeration of readiness. Some demonstrations relied on incomplete prototypes. Key claims were unsupported by engineering data. Internal warnings were dismissed as obstacles to momentum. Investors relied on public statements rather than independent verification. Why it happened was market incentive. Speculative environments rewarded ambition over evidence. Due diligence lagged behind enthusiasm. Media coverage reinforced narrative instead of documentation. What went wrong was governance. Marketing outpaced engineering. Oversight mechanisms deferred to executive optimism. Skepticism was treated as disloyalty rather than risk management. The consequences followed disclosure. Nikola's valuation declined sharply. Milton resigned and was later convicted of fraud. Investors absorbed losses. The case showed how easily aspiration can be converted into fact when markets prioritize speed, and how correction arrives only after records replace stories. Bernie Ebbers. Bernie Ebbers was a telecommunications executive whose accounting fraud was exposed on the 2nd of June, 2004, in New York City, United States. That day, federal authorities arrested the former CEO of WorldCom after investigators uncovered one of the largest accounting manipulations in corporate history. During the late 1990s, WorldCom expanded rapidly through acquisitions, presenting itself as a dominant force in global telecommunications. When growth slowed, pressure to meet earnings expectations intensified. What happened unfolded quietly inside the accounting department. Routine operating expenses were reclassified as capital investments, inflating profits by more than $11 billion over several years. The changes were made incrementally, often after business hours, by a small group following executive direction. Each adjustment appeared minor in isolation. Why it happened was tied to expectation. Market confidence demanded continuous growth. Internal culture discouraged dissent. Senior leadership treated financial reporting as a tool to manage perception rather than reflect reality. What went wrong was cumulative normalization. Auditors reviewed statements that appeared consistent with prior quarters. Analysts accepted reported numbers as confirmation of strategy. Internal concerns were overridden or delayed. The consequences were extensive. WorldCom filed for bankruptcy, eliminating thousands of jobs and erasing investor wealth. Pension funds and individual shareholders absorbed losses that could not be recovered. Ebbers was convicted of fraud and conspiracy and sentenced to 25 years in prison. The case demonstrated how routine decisions, repeated without resistance, can quietly accumulate into systemic collapse. Carlos Ghosn. Carlos Ghosn was an automotive executive arrested on the 19th of November 2018 in Tokyo, Japan, for alleged financial misconduct. Ghosn was taken into custody shortly after landing in Japan, accused of underreporting compensation and misusing company resources while leading Nissan and a broader multinational alliance. His leadership had previously been credited with rescuing the company from near collapse. What happened involved complex compensation arrangements. Portions of Ghosn's income were deferred, routed through affiliated entities, or excluded from disclosures. The practices relied on differences in reporting standards and oversight across countries. Documentation existed, but interpretation varied. Why it happened was concentration of authority. Ghosn's success reduced internal challenge. Boards deferred to executive judgment. Compliance mechanisms relied on trust, rather than transparency. What went wrong was structural imbalance. Oversight was fragmented across jurisdictions. Internal governance failed to adapt to the scale of executive power. Financial clarity became optional, rather than enforced. The consequences were destabilizing. Nissan's leadership fractured. Legal proceedings extended across borders. Ghosn denied wrongdoing and later fled Japan, complicating resolution. The case did not end with a single conviction or collapse, but with prolonged uncertainty. It illustrated how executive dominance can erode financial boundaries slowly, leaving institutions functional in appearance while accountability recedes from view.